Hi, I'm Jim Cunningham, and welcome to Why Retiring in California May Actually Be a Smart Idea. So you hear a lot of people leaving California for a lot of different reasons. I'm here today to make the case of why you might want to think about staying in California. So I'm a lawyer. I'm talking. This is not legal advice. This is just information. So please don't go out and do a bunch of stuff. I'm the managing partner at CunninghamLegal. I've got 25 years plus experience. We have offices throughout California. I'm a certified specialist in estate planning, trust, and probate law, also a real estate broker and securities and insurance licensed, and also a pilot. And if you're watching this on YouTube, go ahead and hit the subscribe button, and these will appear in your feed. It's a great way to stay on top of all of the changes that are happening over the next 4 years, especially we've got a lot of change in trust and estates universe happening in the next 4 years. These are the attorneys at our firm. We've got a great team of lawyers dedicated to estate planning, trust, and tax matters. And these are our offices in Northern, you see the Golden Gate Bridge, and Southern California. So retirement in California. I will tell you, this is a hot topic with clients. We serve a demographic of clients that is thinking about retirement or retired. And a lot of people say, I'm out of here. I'm leaving California. Believe it or not, a lot of people say, I'm out of here. I'm going to California because they're from a different state. So we do get a fair amount of people moving to California. And I think what you're going to see as we go through these materials, picking on one topic, taxes. There's a number associated with that. It's a percentage, it's a dollar amount. As humans, I think we want to hold on to something that we can understand easily. And so that's why a lot of people ask, how much is it? Or what are the taxes? Because that's really the only question we know how to ask. But we're going to go a little bit deeper on this. And what I'd like you to do is just kind of empty your mind a little bit. As we go through the materials here, for many people, leaving California is not such a good idea. And for many people, leaving California is a good idea, or coming to California. So it is not true. I will say it is not true that overall taxes are higher in California for everyone. Okay, so there are a lot of different taxes we're going to talk about. And it's also important to think about retirement. I deal a lot with the retired people. I'm not retired yet. I'm 53 this year, I think. But I would encourage you to think about retirement in segments. And what I mean by that is many of our clients retire at age 60. Some retire in their 50s, but a lot retire right around that age 60. You don't have Social Security yet. You may be living off savings. You're not yet tapping into your IRAs or your 401ks. And people in their 60s oftentimes have grandchildren, but sometimes they don't have them yet. And it's a great opportunity to travel, barring a pandemic. It's a great opportunity to travel and do all those things you wanted to do while you're still healthy, right? And you still have the energy to do them. So I think thinking about retirement in your 60s maybe is a little bit different than thinking about your retirement in your 70s, right? Because in your 70s, that's when you typically start having a required minimum distribution from your IRAs. And for a lot of our clients, now that age is pushed back to age 72, but for a lot of our clients, they're really surprised that they have to take money out of their retirement account. So the tax bill goes way up. And that is one of the downsides, as we'll see, of living in California. Once you hit those RMDs, those required minimum distributions from your retirement account, your tax bill oftentimes does go up. And of course, also in your 80s, I would say typically by the time people are in their 80s, they are less active. They're relying typically more on their adult children for help. And again, I'm making sweeping generalizations. But there are many other reasons other than taxes to remain in California or move to California during retirement. So we'll see what those are. So factors to consider in retirement. I think the big one, and I'm just going off my observation from talking to literally thousands of people who are retiring or getting ready to retire. I would say proximity to family, friends is probably the number one consideration. A lot of people do cite taxes, but in reality, if you're lucky enough to have children, or unlucky, I suppose. But if you're lucky enough to have children and grandchildren, typically people want to be around them. Also, culture. That's a very broad term. What's a right cultural fit for you? And also activities that are of interest to you. If you move to a place, if you love snow skiing and you move to Florida, that's not happening, right? So think about the activities that are of interest to you and have that be aligned. Kind of has to be the right fit. if that makes sense. It has to be the right fit for you. Also, weather and climate is very important. You know, some people who grew up in a cold climate, they just say, I can't do cold anymore. It's just not going to happen. Other people love it. So again, this is not a one size fits all. Cost of housing, and I would say the overall cost of housing, not just the nominal price of the house, but the care and feeding that goes into the house, the heating, the cooling, the property taxes, the weather damage. You know, if you live in an area that is prone to hail, that can cause a significant damage to your property. So state, I would say also state and local income and capital gains taxes. We'll talk about that quite a bit. And then of course, county and local property taxes. So our capital gains taxes and income taxes are typically state and federal level, but the property taxes are typically on the county level. So we'll talk about that. So really the question is, where should you retire, right? If you're thinking about it, where should you retire? This is a very personal decision. Obviously, there's not one size fits all on this, but where you live during retirement, I think can significantly affect your financial situation and your quality of life. So the geographic location where you end up choosing to retire, that does have a big impact. And before you assume that you should move in retirement, I think a lot of people say, well, I guess when I retire, I'll leave the big house and move and downsize. Well, many times if you leave your big house, there is not a place for the grandkids to come visit. And that happened with my wife and I in one of the homes that we owned, which was a larger home. And then when our kids left, we sold that larger home when they went off to college. And the people who bought it had downsized. So they were about a generation older. They had downsized and they were like, there's not enough room for our grandkids. So we need more space for our grandkids. So I would say, look closely at your current living situation. I would say it's also a really good idea to visit several areas before you decide to move anywhere for your retirement. I remember a conversation I had with some clients who live in San Francisco and had emigrated from South Asia, and that they just loved the San Francisco culture. They got a little tired of the taxes. Well, it was the husband who got tired of the taxes. And then I was speaking with the husband and wife, and they said, well, we're going to look at new places to retire to, and we're going to look at Texas, and we're going to spend 3 weeks there. And then I had a follow-up meeting with them a couple months later, and I asked them, hey, how did the trip to Texas go? They said, oh, it lasted about 3 days. It's not for them. Now, Texas is for a lot of people. My parents moved to Texas, to Fort Worth, to retire. So I'm not disparaging Texas at all, but my point is that it is a very personal decision where you choose to live. So it's really hard to paint a broad brush here. The major factors to consider in retirement do include the cost of living. It does, things are cheaper in Nevada than they are in California. It's a fact. Taxes are another issue. Amenities are another issue. If you love golf and you move to a place where you can only play golf 5 months out of the year, that's really not for you. Okay. And access to healthcare. I don't think we should underestimate the importance of access to quality healthcare. That's very, very important. So let's talk about the case for retiring in California. California has a lot of things going for it. I happen to be biased. I'm a California native. I am a lifer. I don't think I'm ever moving from California. So just take that with a grain of salt. But we have culture, okay? And I'm going to talk a little bit about what I mean by culture. The weather and the climate. Obviously, California is known for its generally mild climate, although some might beg to differ who live in the desert in the summer. I wouldn't call that mild. But today, it happens to be a sunny day in January. And that's not the case in many parts of the United States. Quality of food. I'm going to talk about, I'm a little bit of a foodie, so to speak, but California does have very high quality food, and and quality fresh foods are available. I think that's very important for your overall health. And also bear in mind that income taxes are low for many retirees, not all, but for many retirees, state income tax just isn't that big of a deal. Okay. Elimination of capital gains tax on death of one spouse, and I put an asterisk on there. That I think is one of the really big benefits of living in California, and I'll explain what that is in a few slides. And something else important to understand, California does not impose a state income tax on your Social Security benefits. Now, you might be surprised by that, but they don't. And so again, it depends on the source of your income. If you are living off of savings, Okay, meaning there's money in the bank and you are withdrawing that money to live on every month. That's not taxable as income, right? You're just consuming your money. If you're living off Social Security and savings, you might find that your state income taxes, frankly, are very small or non-existent entirely. Another thing is California has what is known, frankly, throughout the world as having a stable and often low, okay, but a stable property tax structure. What I mean by that, and I'll explain what that means, is the county, a random county can't just say, oh, we're short this year, let's double the property taxes. They can do that in a lot of other states. You simply cannot do that in California. So let's talk about culture in California. California is the most diverse society in human history. It's a fact. We have more people living in California, more different people than have ever lived in any political organization or structure ever. 2 out of every 5 Californians were not born in the United States. So California has a population of 40 million, 16 million people were not born in the United States. And my wife and I did adopt our 2 daughters we adopted from Russia. And we have 5 people in our family. So we're reflective of that demographic fact of 40% of Californians not being born here. 120 languages are translated in our court system. Imagine that, 120 languages. I mean, I didn't even know there were 120 languages, right? But those are all translated in our court system. And there is a blue California, that would be the Democrats, and there is a red California, which is a Republican. So I would say that there's a place for everyone in California, and this is regardless of race, gender, national origin, wealth, income, or political affiliation. And for those of you who have traveled extensively throughout California, you do know that the eastern half of California is a lot different than the western half in many ways, and one of them being politics, right? You can see the graphic here, that red is a less populated area, okay, with the exception of, I guess, Orange County, but it's a less populated area. So there, yes, there are more Democrats and Republicans in California, but there still are large areas that where people, quite frankly, if you're a Republican and you want to live around Republican people, you can do that in California. If you're a Democrat and want to live around Democrat people, you can do that. So my point is, there's a place for everyone. Culture, I kind of had some fun with this. These are the Compton Cowboys in the upper right-hand corner, and of course, you got a catching a salmon. And we've got snow, we've got surf, we've got the Oakland hipsters, we've got a wide variety of culture, and frankly, it just keeps it interesting, right? Weather and climate, what's to say? What more can we say about the weather and the climate of California? It's absolutely gorgeous. I remember in law school, I surfed one day and skied in the same day. Where else can you do that in the world but California? So this is something that I would not underestimate when you're looking at other places to live. And again, the quality of the food. California grows the most food in the United States. You have the ability to eat local and fresh. 2 of my favorite cuisines, Mexican cuisine, Asian cuisine, fantastic, great seafood, great American specialties. We're the #1 in California, the #1 fresh food grower in the United States. 90% of the lettuce is grown in California, and 47, almost half of the Michelin star, 3-star restaurants in the United States are in California, and there are none in Florida. Now, I'm not dissing Florida. I think Florida is a beautiful state, but my point is the quality of the food and the quality of the cuisine. And then we have low income taxes for many people in California. Okay. And you might be saying, what are you talking about? Isn't California the highest in the nation? Well, it depends. If you make as a single filer $1 million or as a married filing jointly $2 million, yes, you do get pushed into the 13.3% tax bracket. And that's the marginal or the highest rate. But if you make $60,000 a year and you're married filing jointly, your tax bill is $935. I mean, money's money, but we're not talking a huge sum of money. At $160,000 a year, your tax bill is about $8,000. And at $260,000 in income, your tax bill's a little over $17,000. Now, this is married filing jointly. My point in mentioning this is California has a progressive or a graduated tax bracket. So what that means is on income of up to $18,000, your income tax rate is 1%. It's very low. It's only really when you get above 100,000 that your taxes really go up significantly. So and again, you're going to subtract out Social Security, right? You're going to subtract out the money that you're withdrawing from savings. If you have a Roth IRA, and you take a distribution from a Roth, you're not paying tax on that either. So I would say that on a high level, yes, California is a high tax state, but for some retirees, it's not as bad as people make it out to be. And these are the marginal or the highest tax rates throughout the nation. You can see the darker the color is, the higher the tax rate. And you can see the states that don't impose a state income tax. Washington does not impose a state income tax, but it does have a death tax. If you die with amounts a little bit over $2 million, that death tax is up to 20%. California does not have a death tax. Oregon's income tax rate is very high. Minnesota has a flat tax. And what we can see here, and these numbers are a little bit, are a couple years old from this graphic, but what you can see is if you're married filing jointly and you have $60,000 in adjusted gross income with a standard deduction, this is what you're paying in California. It's lower than 1, 2, 3, 4, 5, 6, 8 other states. And look at Oregon. Now, you don't have to pump your own gas in Oregon and you don't pay sales tax, but look at that big income tax bill. The other thing with Oregon, by the way, is a lot of people say, well, I'm going to move to Oregon because there's no sales tax and I can live cheaper. Well, when you're older, many of the things you're buying aren't taxed in California anyway. You know, food is not taxed. Medical services aren't taxed. So something to bear in mind. Now, let's talk about the really big benefit for married couples in California. The catch is somebody must die. Okay. So this sounds like a movie, you know, someone must die. A surviving spouse receives what we call in the law and in accountancy and in tax, you know, the tax compliance space, an adjusted cost basis on community property. So let me give you an example. Herb and Wandine, who are husband and wife, get it, H&W, Herb and Wandine, they moved from New York to California to retire. And they do proper estate planning. And on Herb's death, Wandine can sell their erstwhile community property, meaning their property that they had transmuted to community property. And it used to be community property when Herb and Wandine were alive, but when Herb died, it stopped being community property because only married people can own community property. And Wandine can sell all of that property. Wandine can sell that stock portfolio or whatever it is, whatever property they own, for its date of death value and pay no capital gains tax. Now, this is a tremendous tax benefit. This is a tax benefit that is available typically in community property states. All right. So these are states that were part of Mexico before the Mexican-American War. And I think there is now, Alaska has an optional community property tax structure and Wisconsin has adopted community property. So this is not consistent across the United States. I chose New York intentionally because that is not a community property state. Had Herb and Wandine stayed in New York, there would be some tax to pay when Wandine sold that stock, right? Because there is no community property in New York. So different tax treatment, and there's no limit on this tax. And this could be in the millions or the billions in tax savings, depending on your level of wealth. So there's a really big tax benefit to being a resident of California and owning community property on the death of a spouse. There is no California income tax on Social Security benefits. This is very, very important. They're not taxed at the state level, meaning you don't have that extra 13.3 or 1 or 2 or whatever, you know, the percentage is. However, RMDs, required minimum distributions from your IRAs, and other distributions from traditional IRAs are taxable. And we'll talk more on that in a couple of slides. Let's talk about the stable and low property taxes. We do have a couple of comments here. Charles says, hey, Jim, I just moved out of California last week. I couldn't be happier. Financial impacts in California include RMDs, Prop 19, homeowner property tax exemption, ACA 11, the whole bunch of stuff. Chuck, and Chuck's a good client of ours. You did successfully move to Texas. Congratulations. And Texas is a place for you in retirement. And I'm not saying one is better than the other, but thank you for sharing that. And then Evelyn, the single filer taxes, that's something I had to pick married filing jointly or single, but the single is the rates are the amount of tax you would pay on the same amount of income is higher if you're a single filer. So let's talk about stable and low property taxes. Before Prop 13 in 1978, and if you're watching this, you probably know what Prop 13 is. If you have no idea what Prop 13 is, then go to our YouTube page and you'll find out a lot of information on Prop 13. Proposition 13 is the term that we use to describe California's property tax system. Now, California has a very interesting property tax system. I think it's unlike any other property tax system in the United States. And Prop 13 was passed in 1978 when the average property tax bill in California was 2.6% of its market value. Folks, that is kind of the norm in the United States. It's right around 2.5%, maybe 3%. My parents, I did mention, moved to Texas. Their property taxes are 3%. The values are lower a little bit, but remember there's no state income tax, but the property taxes are that higher percentage. After Prop 13 passed, the amount that the county could tax you on your property dropped from 2.6 to a maximum 1%. Now, some of you know that you're paying a little bit more than 1% because sometimes there's some added local tax initiatives that pass that are based on the value of your property. It has to pass with a 2/3 vote. So it's kind of a big deal. But on a very high level, 1% of the fair market value has to be paid every year in property tax. And that fair market value is based not on the value of the property in any given year. It is based on the value of the property when that property changed hands. So what I mean by that is the date that it was purchased, or the date that it was received by a gift, or by inheritance, the date of death of someone who's leaving property to somebody. The property is reassessed unless there's an exclusion, right? A reassessment exclusion, but the property is reassessed at 1% of its fair market value on the date of that transfer. And those property taxes can only go up 2% a year thereafter until the next change in ownership. Well, what's happened in the last 40 years is real estate has gone up in California on average 6.2% over the last 40 years. So what we see is people who buy a property for a very low dollar amount have very low taxes, and then that value of the property takes off and goes way up. Well, the property taxes don't go up the same amount, right? They're not going up the same proportion. So you may have a very valuable property that is paying a relatively low property tax. Check out our YouTube page on this. We have a lot of content on this. We'll walk you through the details, but let me give you an example. Hal and Wanda buy Greenacre in 1975 for $50,000. It's now worth $2 million. But Hal and Wanda's property tax bill is only $1,500 a year. If Hal and Wanda move to Texas and buy a $2 million property in Texas, their property tax bill, you can add a zero to that. It's going to be $15,000. Actually, if they buy a $500,000 home in Texas, right? It's going to be a very high property tax bill. But in California, my point is, are the taxes really higher in California? Well, the property taxes for Hal and Wanda aren't, because they've owned the property for a very long time. Now, California has no income tax. Texas has no income tax, but Hal and Wanda would have to earn more than $250,000 a year in retirement to break even on the income tax savings. So let's look at Hank and Wendy. We're going to do a case study of Hank and Wendy, and I really want you to pay attention to this, because this kind of brings together a lot of these concepts that we've been talking about, which is thinking about your retirement in a segmented way, in spans of years, not just I'm going to retire and I'm going to stay here for the next 30 or 40 years, but be a little bit more open-minded to different strategies that are available to minimize your taxes and maximize your wealth creation over a period of time. So Hank and Wendy are in their their 60s and have recently retired. They have $1 million in 401ks and $1 million in other assets, and they want to travel before their grown children have children of their own, and they are eager to do a Roth conversion. So what a Roth conversion is, what Hank and Wendy want to do is they want to take that $1 million 401k, pay the tax on it, right? And convert that to a Roth, so that the future distributions from the retirement account, even if it grows, the future distributions are not taxable as income. Well, in the first year of retirement, Hank and Wendy spend 3 months in Hawaii. What's not to like, 2 months in France and 7 months in Nevada, and no time in California. So they completely leave California. Are they still residents of California, even though they physically left, and therefore subject to California state income tax? Well, it depends on a very important concept in the law called domicile. And it's from the Latin root for home, is where do you consider home? Right? So domus would be the home in Latin. So where do you consider your home to be? Well, it's where you voluntarily establish a present intention of making your true, fixed, and permanent home and principal establishment. It's where you consider in your heart of hearts your home. Now, the problem is the state of California can't look into your heart and see, where do you feel home is? But basically, when you leave, if you have an intent to return to the home, if you have an intent to return to California, then it's still home. Well, where do Hank and Wendy really think of when they think of home? There are factors beyond what is in your heart to consider in determining a non-California residency. So these are factors that support termination of California domicile. All right. So this is if you want to leave California. These are some indicators that you have left and that you're no longer a California resident. Well, the first one doesn't really work because Hank and Wendy are retiring, but full-time employment in a new home state, yeah, that's a pretty big indicator. All right. You move to Florida and you get a job in Florida, you're a Florida resident. I mean, that's one indicator. Few or no days spent in California after departure. Okay. So some of you might have heard you only need to spend less than 6 months in California. I'm not sure that's totally true. I think it depends on a lot of other factors, but factors that support your termination of being a California domiciliary do include minimal or no days in California, moving all your stuff out of California. That means all your stuff that you move out of your house, don't put it in the storage unit in California, put it in Nevada, right? It's where your stuff is. Getting new doctors, dentists, social relationships, joining a country club, joining a church or synagogue, or ongoing activities in a new home, whatever it is, being involved in that community, playing pickleball. I don't know. There's a laundry list, right? You figure it out, but it's joining these organizations and quitting the old organizations in California, right? And then, of course, changing your voter registration, your driver's license. And if you have a professional license, if you're a realtor, then you become licensed in that state. If you're a lawyer or a doctor, you become licensed in that state. So factors that don't support a termination of your California domicile. And the biggie here is maintaining a home for personal use. So if you leave California and you still have a home in California that, you've checked the homeowner's exemption and you still own it, and you're using it for your own personal use, that is just a black letter law. That's going to be arguing in favor of you not terminating your California domiciliary status. So that's a tough one for a lot of people. Continuing to work in California on a regular basis would be another one. But again, if you're retiring, it's not an issue. Weeks or months spent in California. So you can see no or a few days, and then weeks or months. You can see there's the more time you spend in California, the more of a connection you have to California, the more likely California will treat you as a domiciliary, that you're a resident of California. Not maintaining a permanent home outside of California. So it's kind of the flip of maintaining a home in California. So if Hank and Wendy do want to separate themselves from California, they should buy a condo, rent something in Reno or Las Vegas or somewhere in Nevada or outside of California. And then also a short time away from California followed by a return. So this would be like, I leave California for 2 weeks, I come back for 3 days. I leave for 2 weeks, I come back for 3 days. That is not supporting a termination of your domiciliary. So what do Hank and Wendy do? Hank and Wendy rent their California home out. They rent it out. They buy a condo in Reno. They change their vehicle registration to Nevada. So they've got Nevada plates. They change their voter registration, join a private club golf club in Reno, and get a Reno dentist and a Reno doctor. Hank and Wanda are no longer California residents. Okay. They successfully removed themselves from California. The rent that they receive on their California home will be considered California source income and subject to California taxation, even though they're not a California resident. In the second year of retirement, in their early 60s, Hank and Wanda have no income. They've retired. They have not yet started collecting Social Security. They're living off the $1 million savings outside of the 401k. This is really important. They have no income. Okay. Hank and Wanda work with their A team. And if you've seen other webinars or other videos on our YouTube, you've seen that picture of the A team from the 80s. And when I talk about the A team, it's kind of like the three-legged stool. It's the lawyer, the financial advisor, and the CPA. But working with their A team, Hank and Wanda roll over Hank's 401k to an IRA and then do what we call a backdoor Roth conversion. So what that means is that $1 million goes from being a taxable account, and it moves, that $1 million moves into a Roth account. You have to pay the tax on that, but they have no other income. They're going to be paying a much lower dollar amount in taxes. There's no state income tax, remember, because they're not California residents. They have no other income, and they're going to be paying the federal tax, and they can pay that out of their other $1 million that they've got outside of their 401k. or not by there are other planning strategies that many times we can use to mitigate that tax bill. But where I'm going with this is, I intentionally described Hank and Wendy being in their early 60s. They're going to go back to California, but they're traveling, right? And they're spending a lot of time abroad. They're spending a lot of time, just enjoying Reno and doing the Roth conversion. So they're bypassing paying the state income tax to California, because that would be a significant number, be close to maybe $100,000 if they, if they were a California resident and did that Roth conversion and didn't do other planning. So they roll over their 401k to an IRA, do the backdoor Roth conversion. They're no longer California residents, and this Roth conversion is not subject to California income tax. Also with a Roth, remember, there's no RMD requirement going forward. You do not have to take money out on your own Roth conversion that you've done. And so I think you see where I'm going with this. In their fifth year retirement, in their mid-60s, Hank can want to move back to California. Now they can take tax-free distributions from their Roth IRA or not. They've already paid the tax on that. That Roth can keep growing. And even though that Roth has grown, they still don't pay tax on that growth. I mean, this is a Roth IRA. If you watch any of our webinars, you see me, I keep beating this Roth IRA drum. This is a fantastic strategy, okay? Because those were going to be really big RMDs when they hit 72, when they're back in California. They also don't pay income tax on their Social Security benefits, and they move back into their home. So they kick out their tenant, they move back into their home, but they're too far from their newly born grandchildren. So what do? 2 years after returning home, Hank and wanted to sell their home for $2 million with its $1,500 per year property tax bill and purchase a beautiful home close to their grandchildren, and they keep their low $1,500 a year property tax bill, right? They do that because of Prop 19. Now, Prop 19 was passed, made a lot of people upset. There are a lot of problems with Prop 19, but there's a lot of good stuff in Prop 19. Hank and Wendy are able to move, and what they're able to do is they're able to take their property tax base with them. So Hank and Wendy are one example of looking differently at retirement. They don't see retirement as static, but a well thought out multi-year strategy that checks all the boxes, which ultimately is proximity to family and friends, culture and activities, being the right fit, climate and weather, cost of housing. They've kind of conquered this issue of avoiding state income tax on the Roth conversion because they were not a California resident when they did their Roth conversion, and they're able to preserve their low Prop 13 taxes. So I would say Hank and Wendy are one example of how retiring in California is possible. But it does require thought. It does require planning. It does require a multi-year, thought process. So Gary asks, when all the properties are held in trust, does the surviving spouse receive the adjusted cost basis? Gary, yes, if they're held in a revocable living trust, that is correct. If they're held in an irrevocable trust, that can be problematic. But for our purposes here, it's generally the living trust. In the Antelope Valley, it's 2% because of all the added fees. Gary, you're absolutely right. So 1% is the ad valorem, or that's Latin for deriving from the value. If your property is worth $100,000, the taxes are $1,000 a year, but they can be $2,000 a year, right? They can be 2% if there are local taxes added on those. School bonds, you'll see a lot of vector control, which is for mosquitoes. They might have a sewage bond or a water bond, but those are added. And also don't forget Mello-Roos, right? Mello-Roos was a way to get around the tax caps of Prop 13 and still do new development. Are domicile rules the same across all the states? I don't know. I think they're similar concepts. Are they the same? No. Are they similar? Yes. These are pretty widely accepted concepts. So being a resident of California, I would say people do things for a reason. They do things for a season, or they do things for life. And this is just what I've seen in my practice. Some people move to or from California for a very specific reason. It can be a job. I got a job in Florida. I'm moving to Florida. It's a 3-year engagement. I'm coming back, right? Or I'm moving to California. I've got a job at a tech firm, and I'm going to be in California for this period of time. Typically, the jobs pay higher in California. Many people come to California to care for a relative, typically an older relative who maybe is protected by Prop 13, right? And taking care of a relative. Also, public assistance benefits. California has some of the most generous public assistance benefits in the United States. Many people come to California to get those, right? And that's just a fact. Some move from California for a season. A Roth conversion, if you have a large Roth, if you're 60 something and you've got $1 million or $2 or $3 or $4 or $5 or $10 million IRA, and you're going to turn that into a Roth, really give this some consideration, because when the numbers get big enough, it covers the kind of the hassle factor associated with moving. And you leave California, you do your Roth conversion, you come back. Now that's over a multi-year period, but that's something absolutely that is a strategy that's available. And then some move to or from California for life. I mentioned at the beginning, I was born in California. I'm a lifer. I don't really see myself moving from California ever. But some people choose to stay here or move here to be typically closer to family members. So I would say the key takeaways from today, I would suggest that you take a decades-long view with retirement, not have it be static. Give it some thought. I'm not sure that people think enough about retirement. It just kind of happens and they go, wow, I don't even need to know what day it is or what time I wake up in the morning, right? I'm retired. But, put some thought into it. Don't focus myopically on California's high income taxes, the 13.3% income tax rate. Don't treat this as a do-it-yourself project. Find your A team. That's your attorney, your CPA, your financial advisor. And I would say for those of you who have assets of 10 million and above or income of $1 million, consider a family office in addition to your A team. That's an offering that we have at our firm. And it's not for everyone, but for those that it's for, it's very beneficial. Basically, our family office focuses on taxes and creating intergenerational wealth. So subscribe to our YouTube channel. If you haven't hit the subscribe button, go ahead and do that. And we've got some questions here. This is our website. So if you'd like to book an appointment, you can click that book an appointment button there and arrange a time to meet with one of our lawyers. And if you enjoy our webinars, please review us on Google. I will open it up for questions. We have several questions here. Let's see. Aaron asks, hi, if Hank and Wendy did everything but rent the house, i.e. just let it sit there vacant, but register to vote driver's license, buy another home somewhere out of California, would that establish residency outside of California? Good question. I think I don't have the answer to that. I think you're probably taking excessive risk by not renting it out, quite frankly. Are there some other planning strategies you could do? Perhaps, if you had a kid move in there or a relative move in there, but it really needs to stop being your personal use asset. Ray asks, how do they keep their low $1,500 property tax bill when buying a new home in California? Ray, I want you to go to our YouTube page because we walk through the benefits of Prop 19. So what Prop 19 says, if you're 55 and over or the victim of a wildfire or natural disaster, you can sell your home and buy another home, let's say it's the same value, anywhere in the state of California and take your Prop 13 taxes with you. That's a big deal. Now there's some requirements. You have to have the property as your claim the homeowner's exemption. The property has to be reassessed when you sell it or when you transfer it, right? Typically a sale. There's some other requirements in there, but it's a fantastic benefit for Ray, for people throughout California who have the low Prop 13 taxes. Janice asks, as a California resident, do you get a stepped up tax basis on rental property? What if it's held as an LLC? Janice, complex question. As a California resident, you get, if you're married, I'm assuming you're married, you do get a step up in basis in the rental property. If it's held as an LLC, it depends if it's a single member LLC or a multi-member. If it's taxed as a disregarded entity or a partnership, the rules are a little different. I would say broadly speaking, yes, but there may be some stuff you have to do shortly after death. And if the rental property is in Nevada, Nevada, I believe, is a community property state, so you're going to get an adjusted cost basis there as well. When the tax bill includes Mello-Roos, how does taxes move to the next house that does not have Mello-Roos? Okay, anonymous. I lived in a house with Mello-Roos. It drove me nuts. Mello-Roos is a line item. So what we're talking about is when you sell your home, your base year value. So the base year value is the year that's the term they use to calculate your 1% tax. That's a number. You take that number to a new house, and that's the number that they use for the 1% tax. The Mello-Roos does not go with you. The Mello-Roos stays with the house that you're selling. So that just the next buyer has to deal with the Mello-Roos. So that's what happens to Mello-Roos. So it doesn't go with you. It stays with the property you're leaving. How long do you have to be away from California to do a Roth conversion and not pay California income tax? Susan, great question. I don't know. Probably to be safe, a couple of tax years. Janet asks, can we do the IRA to Roth conversion during the year that we move to California? Let's say we move from Florida in November, but do the conversions in February before we get to California. Janet, you're probably better off doing them in the year that you're not in California. There is this stub year issue. And if you're moving to California, that's a question for the A team, which this would be the CPA. I would not want to give you an answer to that if I wasn't 100% confident. But if you're not a California resident and you do a Roth conversion, California can't tax it. That's just a general rule. The issue is if you do your conversion in February and move to California in May, is California going to tax you? Probably not, but I would definitely tread carefully on that. Again, this is not legal advice. This is just information. What Jerry says, with Prop 19, can anyone of a certain age move anywhere in California and keep their low property tax? Jerry, no, you have to be 55 and over, or the victim of wildfire or natural disaster, or be disabled or unable to work. So what are the pros and cons about Florida? Florida's nice. I like Florida. It's flat. Some people say it's going to be underwater. Miami's going to be an island soon. I don't know. But this is stuff that, I would say this is the part where you have to figure out what's the right place for you. If you like fishing, gosh, Florida's fantastic. When Hank converted the $1 million to the Roth, was this converted over multiple years since the federal income taxes are due in the year of conversion? I just did it in 1 year. There are reasons why you would do it in 1 year versus spread it out. Most advisors would counsel clients to do a tax bracket arbitrage. What that means is the federal taxes go up the more taxable income you have. So what a lot of people do is they will do, maybe in that case, 200,000 a year, or 150 or 250, but sometimes they do the whole IRA. That's if you think your investments are going to go up. Okay, so you would want to do that now rather than having those investments be higher. That would be a reason to do it all at once. Or the government stops letting you do the backdoor Roth conversion, which is a possibility. This could go away. Michael asks, what should they do if the retirement is at age 72 with regard to Roth conversion? That's a great question. Again, I would say meet with your A team on the Roth conversion. Some people find that they do a Roth conversion and they're not paying much tax at all because they have some other stuff going on their income tax return. But I would say generally your biggest bang for the buck on Roth conversions is going to be before you start your minimum distributions, but some of our clients still do them after they hit minimum distribution. Does changing it to a rental change the property taxes? Anonymous, in our case, it did not. But if you inherit a property from a parent with Prop 19 and you claim that home as your homeowner's, right, as your home, and you move into it, and then you later move out, as I read the law, the property taxes would go up. I don't know how that's going to be enforced. And everyone's trying to figure that out right now in California, frankly. What are the federal taxes on a Roth conversion? It's just straight income. Right? So whatever, it's just added to your income. If the LLC is in the name of the husband and wife, when one passes, the other will pay more taxes. Pay more taxes, your income taxes will go up if you're married filing singly. I think that's what you're asking. Charles says, great webinar. Thanks, Chuck. Appreciate that. Cindy says, how long do you need to occupy a home and claim it as a primary residence before you can sell and transfer your property tax? This is a great question. I would say, Cindy, 2 years is probably safe, but it should be on the tax bill. So if you move into so the couple of things we're talking about here, one is a 1031 exchange, okay? That's if you transfer a rental property and then later move into it and then sell the property, you have to be there 2 years. When it comes to property taxes, you need to have your homeowner's exemption box checked on that home that you're selling. And then when you move, you buy the property, that property gets reassessed, you file a form with the county where that new property is located, and later they drop your bill and they give you a refund. but you have to claim that as your homeowner's exemption. So I think on that one, Cindy, it's going to be the homeowner's exemption. I hope that answers your question, but we have a lot of content on our YouTube page on Prop 19. Anonymous asks, when a primary home is in an irrevocable trust, transferred from a living trust due to Prop 19, does the step up in cost basis apply? Anonymous, it depends on how that trust is written. So when we did Prop 19 planning, we had a couple variants of trusts. One variant was on the death of the parent who was giving the property. The property does get an adjusted cost basis. I would say, though, when it comes to people who did planning before Prop 19 became effective in February of 2021, those are long-term hold properties. So getting an adjusted cost basis wasn't as big of a deal, but it just depends on what the trust says. And if you'd like, we could certainly go over that with you, and you could just make an appointment and we could help you out with that. Anonymous says, should you pay off debt first before planning for retirement if you're 20 years till retirement and none saved? Anonymous, I think you need to meet with a financial advisor on that. I would not be doing you a service if I told you yes or no. I think it's different for everyone. There is a case to be made for investing, even though you have debt. And so personally, I mean, my wife and I were investing. I had student loans. We were investing and we had student loans, and it worked out. But again, I think that's a question for a financial advisor. Julie asks, I just sold my condo in California and I'm renting. Have I lost my opportunity to use Prop 13, or do I have a little time to buy the next property? Julie, you do have time to buy the next property. I would definitely pay attention to that. I believe it's 2 years. Don't hold me to that. It also depends on your age. I'm assuming you're 55 or over, but that's something we could certainly help you out with, and calculate the date, right? This is another reason to have someone who's knowledgeable about this. We look at the date that property closed, and then we can give you a real answer, which is you have until this date to purchase a new property, okay? And it also depends on when you sold the property and when you acquire the new property. Tina asks, isn't there talk about the government doing away with allowing Roth conversions? If so, when will that happen? Yes, Tina. What we're calling a backdoor Roth conversion, that may go away. All right. So if you're thinking about it, really look at it, because this may go away. So if you're thinking, wow, this Roth conversion might be for me, I think I would, get going on that with your advisors. Anonymous asks, if you're over 55 and you sell your home, is the benefit only for those who buy a home of the same value? Anonymous, great question. It used to be back in the olden days, the pre-Prop 19 days, you had to buy a home of equal or lesser value. Great question. You can buy a home of equal or lesser value and you keep your Prop 13 taxes. Now you can buy a home of greater value. So if the home of greater value is greater by $100,000, you keep your Prop 13 taxes, and then you add another $1,000 or 1% to your property tax bill going forward. So great question. You can buy a home of greater value. Prop 19, I will tell you, Prop 19 is probably the single biggest needle mover. If you're thinking about retiring in California and own property in California, probably the single biggest needle moving law, because now you can move anywhere in California. You can buy a home of greater value or lesser value and keep your Prop 13 taxes. And it used to be you could only do that in 10 counties. You either had to stay in the same county or one of 10 counties. And I will tell you a pattern that we see with a lot of our clients live in the coastal areas, the Bay Area. They might live in LA or Orange County or San Diego, and their kids live inland because they can't afford to live where the parents live. So the kids might have moved to, Sacramento, and the parents, they're in LA. They go, well, I want to see my grandkids, and Sacramento's a nice place. Let's move up there. Let's move to that area. So now you can take your Prop 13 taxes with you. Great benefit. If the house is in trust from the parents under Prop 19 and you move, do you keep the tax base? Cynthia, that has to be your home. I don't know about that. That would be one where we'd have to help you out with that. But that was part of the appeal for clients during Prop 19, is they could pass their home to their children as long as the child claims that as their residence, and you're over 55. I would presume that you could transfer that residence to a new one. But again, I wouldn't, don't go to the bank on that one. I'd want to meet with you one-on-one. What states do you work in? Our office is based in California. We have attorneys licensed in Washington, Texas, Missouri, Virginia, and I believe New York and DC. So we work in a lot of different states. We can also, certainly if you're in another state and you need a referral to a lawyer, we can certainly refer you to a lawyer. What's the income limit for married filing jointly to convert to a Roth? Nothing. That's why it's called a backdoor Roth. So typically under Roth, if you make over, I think it's 160, you can't contribute to a Roth. But if you have an IRA, you can convert that to a Roth. So that's what we're talking about. If we inherit a property and mom did a reverse mortgage and had to refinance the house, then Prop 19 law changed. What options do we have to retro back and not have to pay the higher taxes due to Prop 19? You really don't, because you would have had to had a change in ownership before Prop 19 was effective. So Anonymous, based on what you told me, I think that ship has kind of sailed. So Blair, all right, thank you. And we have chat. Let's see. When is a good time to plan for retirement if you're paying off debt first? Lucretia, that's a great question. I think that's a question for a financial advisor more than it is a lawyer. It's kind of a math question. Do you have an office in Nevada? David, not yet. Can you refer us to a trust lawyer in Nevada? Absolutely, David. Go ahead and reach out to us. We can refer you in either in Las Vegas or the Reno area. I'm assuming those are the two areas that you're closest to. And then we have another question. Is there an age limit as to when you can transfer from a traditional to a Roth IRA? No, you're just paying tax. So, well, with that, it's been great spending time with you, and please check out our YouTube page, and we will see you next time.